Your tax return might look totally normal, but it could be quietly signaling that you missed out on thousands of dollars of tax-saving opportunities. And for federal employees and retirees, especially those we call middle-class millionaires, these mistakes can compound for years and years and cost you greatly over time. Today, I'm going to show you 3 tax red flags that I look for, why they matter, and what planning strategies may help reduce the damage before it's permanent. You might think that having low taxable income on your tax return is a good thing because, well, that means low tax. But when I see a federal retiree with low taxable income, that could mean that some significant planning opportunities were completely missed. For example, a couple filing jointly could pay 0% tax on capital gains for almost up to $100,000 of taxable income in 2026. So if a federal retiree has low taxable income and they're not intentionally harvesting capital gains, they could be missing out on paying 0% tax on that growth, which in the future could cost them 15% tax or even more. We have many clients who benefit from this strategy, and all of that investment growth they get to keep totally tax-free. Another example is Roth conversions. If your RMD projections show that you're going to be in the 22% tax bracket or maybe even higher when you take those RMDs, then seeing a low taxable year means that you probably could have converted in the 10, 12, or really any bracket that's below your future projection and saved yourself a ton in tax. And remember that Roth money now also gets to have all of its growth completely tax-free as well, so long as the rules are being met. Whereas your pre-tax dollars, even though they're not taxed until the money comes out, as they grow, they create future taxes for you more and more over time. So look for ways to fill up those lower brackets, especially in years that you have the advantage, and use the tax law to your advantage. When you combine these strategies, you can experience massive value in your retirement plan in the long run. Okay, now here's the part of the tax return that most people skip over. While retirement accounts are only taxed when you take money out of those accounts, non-retirement accounts are constantly under tax pressure. This is when portfolio design really starts to show up on your tax return. Let's look at an example of a report I ran for a new client so that you can see how to start thinking about this for yourself. This report that we're looking at is essentially a health check on someone's tax return, and it tells us a lot of information about what's going on in this person's financial life. Now, the first thing that sticks out to me is that most of the portfolio income or the interest that was generated on this is taxable rather than tax exempt. So for this family, I would like to see them start to transition a lot of this taxable income into tax exempt because this could mean that it's a sign of inefficiency. Now, on their dividends, they do have a good mix of qualified versus non-qualified dividends. But the difference here is that non-qualified dividends are taxed at a much higher rate than qualified dividends. So the taxation on qualified dividends, if you don't know, is considered ordinary income. So just like your salary, which is the highest form of tax that we have. So if we can, we want to start moving this to the qualified dividend so that they get preferential tax treatment. Now, I do see that with capital gains, at least we have very little. In fact, here they had negative capital gains, or capital loss as we call it, under short term, while everything else was long term. This is what I like to see. Okay, so again, long term versus short term. Long term capital gains are going to be taxed at a much lower rate than short term. Short term, again, just like non-qualified dividends, are going to be taxable just like a salary, which is the highest form of tax. Now, beyond these 3 up the top, I also want to point out this next section here. And this report is showing us that this family is actually subject to an additional tax, which has to do with the amount of income that was generated on their tax return. So in this case, because they were over this threshold, they're now taxed an additional 3.8% of this amount of income, or the modified adjusted gross income, on their tax return. So for them, we can see here, this was actually over $4,000 in extra tax that they had to pay in this year. And the truth is, when I see reports like this is something that is annual. So possibly $4,000 every year that could have been avoided by structuring the portfolio income a little bit better. Now, you might be thinking, so what? They had high income, they can afford to pay the tax, they should pay more tax. That's true up to a point. In retirement, you get to design and create the income that you're generating. And there are ways to create the same or similar amounts of income, but with much less tax along the way. This is about optimizing your wealth and using the tax laws to your advantage. Another way I see this creep up on people's tax returns is through something called capital gains distributions. So if you own non-retirement accounts, so things like individual, a joint account, trust account, any registration that's non-pre-tax traditional or Roth, then you might have to pay capital gains on your investments even if you didn't sell anything in that year. How is that possible? I see this a lot when feds come to work with us, where they might have some mutual funds that they bought a really long time ago, or maybe they inherited some mutual funds and they've just held on to those investments. And if you own mutual funds in a non-qualified account, then you already know right around October, November, that mutual fund is going to distribute its capital gains to you as a shareholder. And again, this happens even if you didn't sell any of your shares, you're still going to have to pay the tax because of what happened inside that mutual fund. So, how do we fix this? First, we need to start with properly constructing a portfolio. The structure and holdings, which account holds which investments, these are all going to have a huge impact on the way that your portfolio efficiency and tax plan comes together. Then, throughout the year, you can implement tax gain harvesting, where market movement can create tax savings for you over time. Then also, if you have an investment with a lot of embedded capital gains over the years, and you are also philanthropic, so you're writing checks or donating to a charity or your church or anything like that, you could use something called a donor advised fund where you are gifting those shares instead of cash to the charity directly to the fund. And then from the fund, you can send it to your local charity. So what's the benefit of doing this? You get the deduction for the gift, you don't pay the capital gains, and neither does the charitable organization. This is something where everybody wins. Now, this next one is going to sound like a contradiction to what I just said, but stick with me, it'll make sense by the end. Remember how I said we want to be careful in taxable interest and instead look to tax-exempt interest? Well, sometimes tax-exempt interest can actually be worse for you. How? Because of how tax-exempt investments actually work. Let's take municipal bonds, for example. Most muni bonds are going to be state bonds. So state bonds pay state taxes and are exempt from federal tax. Now, I know some are exempt from state tax too, but that's a separate topic. So if your federal tax bracket is 12 or even 22%, then you would be saving yourself that amount of federal tax on the income earned. Now, for you to really understand how this works, I'm going to do a little bit of math here, but I promise it will be very painless. As of May 2026, AAA rated 10-year municipal bonds are paying roughly 2.93% or so on average. They vary a little bit, but this number is pretty close. Now, AAA rating means that they're high quality bonds. Because we're talking about retirement here, we want to be looking for relatively safe and stable bonds. We don't want anything that's a high risk bond where they're going to pay you more. So just remember, the lower the rating, the higher the interest rate, but there's a good chance you might not actually get paid. This 3% income would be exempt from that 22% tax, which sounds like a really good thing, right? Well, how do you know if that's actually a good amount of tax savings? You have to figure out what is the taxable equivalent from something like a corporate bond where you do pay the tax. And so here's how we do this. It's very simple, okay? We want to take the 3% interest that the bond is earning, and we want to divide that by 1 minus 22, which is the tax rate that we are paying, so 22%. And what this gives us is about 3.85% or so, roughly 3.85%. That means that a 3% tax-free bond is about the same as someone in the 22% bracket looking at a taxable 3.85%. So then the question is, can I earn more than 3.85% and still pay tax and be ahead of a tax-free 3% interest? Now, at the time of recording this video, most money markets are paying somewhere between 3.5%, and a lot of bonds out there are in the 4% or higher, depending on what you're looking at. So you can see that in this case, if you're earning 4%, but you are paying tax and you're in the 22% federal tax bracket, it would actually make more sense for you to pay the tax on your bond interest instead of getting the tax-free, because net after tax, you would still be further ahead. So something like a corporate bond or a treasury bond might actually be better even though you're paying tax on it. Now, I would be remiss if I didn't say that this example we just looked at was done in a vacuum. There are many other factors to look at, such as deductions and a variety of other things that impact what you should actually do. So make sure that you speak to your professionals before doing anything. And the bigger lesson is this: your tax return is not just a filing document, it's a planning tool. It can show you whether you're wasting those low tax brackets, whether your portfolio is creating unnecessary tax drag, and whether tax-free investments are actually even helpful to you. And for federal retirees, these decisions really matter because the time between when you retire and when your RMD actually starts can be one of the most valuable planning windows that you have in your entire retirement. So if this was helpful, send it to somebody you think should hear it as well. And if you're a retired Fed trying to make better financial decisions, then subscribe to the channel. And until next time, stay wise and stay wealthy.